Hello, I'm Mansoor Mohyuddin, and this is Bank of Singapore Research. Financial markets are likely to remain challenging as 2022 draws to a close. First, the Federal Reserve is increasing interest rates aggressively by 75 basis points at each meeting to curb inflation. The Fed's tightening cycle this year has been its most rapid since the early 1980s. Its large interest rate hikes have caused equities, treasuries, credit, and emerging markets all to weaken sharply. The central bank will likely end its interest rate hikes in early 2023 when inflation starts to decline towards its 2% target. But this year, the Fed is set to stay hawkish until it has clear evidence inflation is finally weakening. Second, China's markets fell sharply after October's National Party Congress. The event appeared to consolidate authority solely under President Xi. There was more focus on security issues rather than economic fears, and there was no signal China's zero-COVID stance would be loosened soon. We expect China's growth will stay subdued until the government shifts away from the stringent lockdowns to curb the virus. Third, the Eurozone and the UK both appear to be in recession owing to the energy shock caused by Russia's invasion of Ukraine. The latest Purchasing Manager indices for both economies show business confidence falling further into contractionary territory. The UK's outlook has been further eroded by the government's recent reckless mini-budget. And last, the Japanese yen has fallen to its weakest levels since 1990 as the Bank of Japan stays dovish on inflation. Investors should thus stay cautious. We continue to recommend being underweight risk assets and bullish the safe haven dollar. We expect the Fed and other major central banks will end their rate hikes early next year to the benefit of financial markets. But until then, the outlook is likely to remain challenging for the rest of this year. For more information, please refer to our monthly investment guide titled Building Resilience.